Okay, picture this for a second. You're sitting in the exam hall. You get a question about macroeconomic stability.
Mm-hmm.
The world outside is, well, it's chaotic. Trade wars are escalating, supply chains are snapping, and geopolitical fires seem to be burning everywhere you look.
Right. It's a very turbulent picture.
And yet you have to explain how India, right in the middle of this global storm, just posted a retail inflation figure of 1.7%.
It is a number that almost looks like a typo, doesn't it? 1.7%. We haven't seen that kind of quiet in the price index for a very long time.
Exactly.
In a world defined by turbulence, that number stands out like a sore thumb, in a good way.
Exactly. It's historically low. But here is the hook, and this is what makes Chapter 5 of the Economic Survey 2025-26 so critical this year.
Go on.
If you only look at that 1.7%, you are arguably missing the most dangerous signal in the economy. Because while the headline number is sleeping, the core inflation, the engine room of the economy, looks like it's overheating.
It does, but, and this is the deep dive twist we are bringing you today, it looks like it's overheating because the entire world is panic buying gold.
Right. And on the flip side, we have this bizarre scenario where your vegetables are essentially in free fall deflation, is the word of the day for the kitchen.
Total collapse in prices.
While at the exact same time, the price of copper is surging. And the culprit for the expensive copper isn't housing or construction, it's artificial intelligence.
It's a fascinating linkage. Artificial intelligence driving global metal prices while domestic supply chains are, flooding the market with onions. It is a structural shift, not just a price cycle.
It's not cyclical at all.
And that is exactly what we are unpacking today.
Welcome to a very special edition of the Deep Dive here on Simplified UPSC by PPP. If you are a serious aspirant or just someone who wants to understand the mechanics of the Indian economy without the noise of cable news, you are in the right place.
You really are.
You're going deep into the machinery of the economy today.
It is great to be back. And frankly, Chapter 5 is usually the dry chapter in the economic survey. It's usually just a list of price indices.
A bit of a data dump.
Right. But this year, it reads like a detective novel. There are red herrings, there are hidden villains, and there is a lot of data that challenges the conventional wisdom we usually take for granted.
We are going to get into every single line of it. But before we dive into the heavy data, a quick welcome to everyone tuning in. We know your time is incredibly precious, especially if you're counting down the days to prelims.
Absolutely.
So we are going to make this hour count.
And we have a community that is growing fast, which is just amazing to see. It really is.
We do. And I have one humble request. If you find value in this analysis, if we help you crack a concept like terms of trade or core inflation today, please hit that subscribe button.
It helps a lot.
And for those of you who are capable and want to support the research team so we can keep the lights on and the deep dives coming, consider joining our paid membership on YouTube. It really makes a difference and allows us to do this level of research.
And a massive shout out to the existing members. You guys are the backbone. Please like the episode and more importantly, leave a comment.
Yes, please do.
Tell us if you agree with the survey's assessment on rural inflation. We read everything, and your insights help us refine our analysis.
Also, housekeeping for the study materials, because we know you need the notes for revision. For the free summary notes and the practice PYQs we will be discussing, check the Telegram channel.
The link's right there.
The link is right there in the description.
And for the Legend members, you know who you are. Head over to the Discord. We've uploaded the premium detailed notes, the extra PYQ bank, and the model mains answers for the questions we are linking today.
Super useful.
Do not miss those. They're designed to be plugged directly into your answers to fetch those extra marks.
Okay, housekeeping done. Let's talk about the mission. We are analyzing Chapter 5, Inflation, Tamed and Anchored.
Tamed and Anchored. It's a confident title, isn't it? It suggests victory.
It really does.
Our job today is to stress test that victory. We are going to look at the global context first, because India doesn't exist in a vacuum.
Never does.
Then we decrypt the domestic story, specifically that core inflation anomaly we talked about.
Then we're going to the food basket, the roller coaster of tomatoes and garlic.
Yes.
And then the section I think is the most critical for mains, the terms of trade between manufacturing and agriculture.
That section explains why, despite all the PLI schemes, people are still staying on the farm. It's a structural warning sign.
It's a huge one.
And finally, we'll look at why Kerala is expensive and Delhi is cheap. Regional dynamics.
And throughout, we are linking this to the syllabus. We have PYQs from 2013, 2016, 2020, and 2025. So keep your ears open.
All right.
Let's start with the big picture. Section 1, Global inflation developments.
Right. So the survey opens with a view from 30,000 feet. If you look at chart V.1 and table I.1, the story is, well, it's one of relief. The global fever has broken. We peaked at 8.7% headline inflation globally in the calendar year 2022. By 2025, that number cooled to 4.2%.
That's a massive deceleration.
Right.
That's the difference between a crisis where you can't afford bread and, a manageable headache.
A manageable headache is a good way to put it. But the recovery is incredibly uneven. You have the advanced economies, the AE, the US, Europe, stabilizing around 2 to 3%.
Okay.
But the emerging markets and developing economies, the EMDEs, are moderating to about 5.3%, so it's still a bit hot.
And where does India fit? Because usually we get lumped in with the volatile emerging markets.
That's the interesting part. India is actually outperforming the average significantly. In the calendar year comparison, India is sitting at 2.8%.
Wow. So well below the EMDE average.
Well below. Now, contrast that with the other Asian giant. China is at 0.0%.
Zero. That implies they are right on the edge of deflation.
Flat.
Yeah.
They are flirting with deflation. It's a completely different pathology. They have weak domestic demand, a property crisis that won't go away, and consumers who just will not spend. Right. India has the opposite issue. Robust demand, but we are managing the supply side effectively.
Now, I want to double-click on the U.S. data point. The survey mentions U.S. inflation declined to 2.7% in 2025. But, and this is the anomaly, their growth didn't tank.
Right.
Standard economic theory, the Phillips curve logic, suggests that when you crush inflation, you usually crush growth, or at least slow it down. Unemployment goes up. The U.S. didn't see that.
That is the U.S. anomaly, and the survey points to a very specific driver: artificial intelligence.
How does AI save the GDP? Isn't it just chatbots?
It's about investment. It's not about consumption. The U.S. saw massive capital expenditure in AI and IT equipment.
Yeah.
When companies buy servers, build data centers, and upgrade software, that counts as investment, which boosts GDP. It also boosts productivity.
I agree.
If your workforce becomes 10% more efficient because of AI tools, you can grow without overheating prices. It acts as a buffer.
That is fascinating. So the tech boom essentially subsidized their disinflation process. They could afford to keep interest rates high to kill inflation because the AI boom was keeping the growth engine running.
Precisely. Now, compare that to Japan. Japan is usually the poster child for zero inflation or deflation.
For decades.
For decades. Now, they're the outlier in the other direction. Their inflation rose to 3.3%.
Wait, so Japan has higher inflation than India right now? That feels like the world has turned upside down.
In this specific snapshot, yes. And for them, it's a good thing. They have been trying to generate inflation for decades.
Right, they've been trying to get out of that trap.
It's wage-driven there. Wages are finally rising. Plus, their currency, the yen, has been weak, making imports expensive. So Japan is trying to escape deflation, while the rest of the world is trying to escape inflation.
And the UK?
What's their story?
Struggling. 3.4%. It's sticky service inflation there. The prices of haircuts, transport, hospitality, they aren't coming down.
So domestic drivers, very much so. And they are facing a dilemma on policy rate cuts. They can't seem to get a grip on it.
So if we look at what actually drove the global cooling, it wasn't just central banks raising rates. It was the commodities themselves, right?
That was a huge factor. Look at charts V.2 and V.3. Oil prices dropped more than 20%.
Which is massive.
It's massive. When energy gets cheaper, everything gets cheaper. Transport, manufacturing, heating, food prices globally also stable, and then dipped into negative territory by late 2025.
But then we have the metals. And this brings us back to that AI point. Iron is deflationary, which makes sense if China isn't building apartments.
Right, the demand's not there.
But copper. The survey says copper surged 32% in late 2025.
This is the supply-side constraint of the future. Copper is the nervous system of the modern economy.
Explain that.
You cannot have AI without data centers. You cannot have data centers without massive power consumption and wiring. You cannot have green energy wind turbines, EVs without copper.
So we have a situation where old economy inputs like oil and iron are getting cheaper, but new economy inputs like copper are exploding.
Exactly, and that is a risk for India. We are pushing hard on digital infrastructure and renewables. If copper stays expensive, the cost of our transition goes up.
That's a huge point.
This is a crucial point for anyone writing an answer on energy security or digital infrastructure.
Let's bring this back to India's performance. Charts V.4 and V.5 talk about the growth-inflation trade-off. The survey calls it a Goldilocks phase.
It really is. I mean, think about it. We managed to lower inflation by 1.8 percentage points while keeping GDP growth at 8% in the first half of FY26.
That is rare. That doesn't happen often.
It's incredibly rare. Usually you have to sacrifice one for the other. You raise rates to kill inflation, and you kill growth with it.
S&P, the rating agency, actually upgraded India's outlook because of this. They used the phrase reaped dividends.
They did. They said monetary policy reform to switch to inflation targeting has reaped dividends. This is crucial for your answers.
Why is that phrasing so important?
Because they are validating the RBI's framework. When the market believes the RBI will fight inflation, expectations get anchored. People stop expecting price rises, so they stop raising prices.
It becomes a self-fulfilling stability.
Exactly. Credibility matters.
This connects directly to a PYQ, doesn't it? I'm looking at 2013 GS3 question 2.
Yes. That question asked about the reasons for introducing the FRBM Act 2003, the Fiscal Responsibility and Budget Management Act, and its effectiveness.
The FRBM is all about the government not overspending, keeping the deficit in check.
Correct. And why does that matter here? Because you cannot have low inflation if the government is reckless with spending. If the fiscal deficit is too high, it pumps too much money into the system, fueling inflation.
So it undermines what the RBI is trying to do.
Completely. The survey is providing the evidence that the FRBM logic works. When fiscal policy, which is government spending, and monetary policy, RBI rates, work together and are credible, you get this Goldilocks outcome.
So when you write that answer, you don't just quote the Acts clauses. You use this 2025-26 data as the proof of concept.
That's the key.
You say, as seen in the Economic Survey 2025-26, credible fiscal discipline allowed India to maintain 8% growth while lowering inflation to 1.7%.
That makes your answer stand out. It proves you aren't just memorizing, you are analyzing. It moves you from a theoretical answer to an applied answer. That is what the examiner is looking for.
All right, let's land the plane in India. Section 2, domestic inflation. The numbers are looking good.
They are. Charts V.6 and V.7 tell the story. We went from a scary 6.7% in FY23 down to a more manageable 5.4% in FY24, and now averaging 1.7% up to December FY26.
And in October 2025, it hit 0.3%. That is effectively zero.
It is. I mean, that's pro-stability by any definition. But we need to explain why. The survey uses two technical terms that every aspirant needs to understand intuitively: momentum and base effect.
Okay, let's break those down. Imagine you are driving a car.
Okay. Momentum is your speedometer right now. Are you speeding up or slowing down compared to 5 minutes ago?
So the immediate change.
Exactly. In inflation, it's the month-on-month change. Are onions more expensive in October than they were in September? That represents the current pressure in the economy.
Yeah, base effect. What's that?
Base effect is comparing your speed to how fast you were driving exactly 1 year ago. Inflation is a year-on-year calculation. So if prices were incredibly high last year, say onions were 100 rupees, that is a high base.
So if onions dropped to 60 rupees this year, the math shows a massive drop.
Exactly. Even if they rise slightly from 55 to 60 this month, it still looks like a huge drop compared to 100 last year.
I see.
The survey explicitly says, in FY26, the base effect was dominant. It pulled the inflation number down mathematically because prices were so high the previous year.
So 0.3% is great, but we shouldn't get complacent. It's partly a statistical gift from last year's pain.
That's the perfect way to phrase it. It's a statistical gift. And we also need to mention the WPI, the Wholesale Price Index. It has been consistently lower than the Consumer Price Index, the CPI.
And WPI tracks the factory gate prices, right? What businesses pay each other.
Yes. And when factory prices are low, it eventually, passes through to the consumer. It's like a leading indicator. Low WPI means manufacturers aren't facing huge input cost pressures, which helps keep retail prices stable.
Okay, now we arrive at the core mystery of the episode. Section 3, decrypting core inflation.
This is the most intellectual fun you can have with inflation data. This is where you separate the casual reader from the expert.
So the puzzle is this. Headline inflation is down at 1.7%, but core inflation, which is headline minus food and fuel, is rising. It hit 4.62% in December 2025.
Right. Now, Standard Economics 101 says, if core inflation is rising, your economy is overheating.
Right. Too much demand.
Too much demand. People are buying too many clothes, too many houses, getting too many haircuts. It usually signals that the central bank needs to raise interest rates to cool things down.
But the survey says, hold on. Look closer.
Yes. It argues that this 4.6% is a mirage. It is being distorted by one specific component in the CPI basket,
Ish.
personal care and effects.
And what is inside personal care and effects? It's not just soap and shampoo.
It is not. It's gold ornaments, silver, precious metals.
This is unique to India, right? In many countries, gold is treated purely as an investment or asset class.
Correct.
But here it's a consumption item, as part of the CPI basket, because buying gold is a cultural necessity for weddings, festivals, and so on.
Exactly. And think about what happened to gold prices globally in 2025. Wars, trade tensions, uncertainty. When the world gets scared, where does money go?
Safe havens, gold.
Investors buy gold. It's the ultimate safe haven asset, so the global price of gold skyrocketed.
So, because Indian grandmothers and brides are buying gold at these inflated global prices, our core inflation metric shot up.
Precisely. It's imported volatility. It has nothing to do with the RBI's interest rates or domestic demand.
Nothing at all?
We aren't seeing an inflation spike because Indians suddenly have too much money to spend on jewelry. We are seeing it because a war in another continent made gold expensive.
And the survey did the math, right? If you strip out gold and silver, what is the real core inflation?
It drops to roughly 2.3%.
That is a game changer. I mean, 4.62% versus 2.3%. Those are two totally different economies.
It changes the entire policy prescription. If you think core inflation is 4.6%, you might raise rates, you might panic. If you know it's actually 2.3%, you can relax.
Right.
The survey is essentially telling the Monetary Policy Committee, don't panic, it's just the gold.
This connects beautifully to 2020 GS1 question 7.
Right. Account for the present location of iron and steel industries away from the source of raw material.
That seems unrelated at first glance. That's industrial geography. How does that connect to inflation?
But look at the underlying principle, the link between global commodities and domestic reality. The 2020 question asks you to understand how raw material availability impacts industry location.
Okay.
The economic survey is teaching us how global raw material prices, in this case gold, impact domestic macroeconomic indicators like inflation.
I see. It's about how the local economy is hostage to the global resource market, whether it's iron for steel or gold for inflation.
Exactly. If you are writing an answer in GS3 about challenges in inflation targeting, this is your example. You write, external shocks in commodities like gold can distort domestic core inflation data, as seen in 2025, complicating monetary policy decisions.
That is a high-level insight. It shows you understand the nuance of the data, not just the headline number.
That's the goal.
Briefly, what about the other parts of core? Are rents going up? Is clothing getting more expensive?
Chart V.15 breaks it down. Housing, very stable. Rents are sticky. They don't jump around month to month.
Makes sense.
Clothing and footwear. Actually seeing disinflation. Prices are going down. Input costs like cotton and leather eased, so prices dropped.
Okay, good news for consumers.
And transport. It bounces with fuel prices, but generally moderating. So the conclusion holds. The domestic economy is not overheating. It's just the gold effect.
All right, let's move from the jewelry store to the vegetable market. Section 4, the food basket.
Or, as I call it, the volatility engine. It's where all the action is.
The data here is staggering. Food inflation entered deflationary territory, minus 5.02% in October. Food was actually cheaper than the year before.
Cheaper. And the drivers were the usual suspects. The top P group, tomato, onion, potato, plus garlic.
What were the numbers?
Look at the drops. Tomato, down 14%. Potato, down 35%. Onion, down 48%.
Almost half price.
Almost half. And garlic.
What about garlic?
Down 64%.
A 64% crash. If you were a consumer, you were happy. But if you were a garlic farmer in Madhya Pradesh, you have just lost your livelihood for the season.
This highlights the brutal boom-bust cycle of Indian agriculture, the cobweb phenomenon.
Right.
Prices go high one year, so all farmers overplant the next year. Supply floods the market, prices crash, farmers burn their crops, which creates a supply shortage, and then prices spike again. It's a vicious cycle.
The survey mentions the government tried to intervene to break that cycle.
They did. It wasn't just passive. They used active supply management. For onions, they didn't just release buffer stocks from warehouses.
What else did they do?
They used the railways. They scaled up rail transport to move massive quantities of onions from surplus areas like Nashik to deficit areas like Delhi and the Northeast.
That makes sense. Trains are faster and cheaper per kilogram than trucks for long distances.
Exactly. It flattens the price divergence between regions. It reduces wastage and it reduces arbitrage, where traders buy cheap in one place and sell high in another.
Now, let's look at edible oils. This is a fascinating case study in trade policy. Chart V by 14.
This is the tightrope walk. Remember, India imports about 50 to 60% of its edible oil, palm oil from Indonesia, Malaysia, sunflower from Ukraine or Russia.
So our domestic price is completely hostage to global prices.
Completely. In early 2025, global prices crashed. Cheap oil flooded India.
Which sounds good for the consumer, but it crushed the domestic mustard and soybean farmers. Their crop was worthless compared to the cheap imported oil.
Exactly. So the government stepped in. They imposed a 20% basic customs duty, BCD.
So they put a tax on imports.
They put a tax on imports. Think about that. The government intentionally made food more expensive for you, the consumer, to save the farmer.
But then the story doesn't end there.
But then the duty combined with a slight recovery in global prices meant inflation started creeping up too fast. So in June 2025, they cut the duty back down to 10%.
It's like a thermostat. Too cold for farmers, raise duty. Too hot for consumers, lower duty.
It is dynamic policymaking, and this links perfectly to 2013 GS3 Question 5. Critically analyze the agricultural subsidy regime with reference to the distortions created by it.
And usually, aspirants write about fertilizer subsidies or electricity.
That's the standard answer. But customs duty is also a form of protectionism, which is a subsidy. By raising the duty, you are implicitly subsidizing the domestic producer by penalizing the foreign competitor.
That's a great point.
When you answer a question on food security or price stability, like in 2016 GS3, use this edible oil example. It shows you understand that trade policy, IS agriculture policy, you cannot separate them.
Okay, listeners, if you have zoned out, come back to us now. This next section is the most important part of the episode for your structural understanding of the Indian economy.
I agree completely.
Section 5, Manufacturing versus Agriculture, the Terms of Trade.
This is chart V.16, and honestly, it's the most worrying chart in the chapter.
The survey compares the GDP deflator for agriculture versus manufacturing. First, expert, we need a simple definition. What is a deflator?
Sure. The GDP deflator is a measure of inflation across the whole economy, not just a basket of goods like CPI. It is the ratio of nominal GDP, which is at current prices, to real GDP at constant base year prices.
Okay.
But think of it as a proxy for pricing power. If a sector's deflator is high, it means the prices of what they produce are rising. They have power. If it's low, their prices are stagnant.
Okay. So what does the data tell us? Who has the power?
The agriculture deflator is at 2.17 relative to the 2011-12 base. The manufacturing deflator is only at 1.41.
That is a huge gap. Agricultural prices have more than doubled. Manufacturing prices are up only 40%.
Correct. And if you take the ratio of the two manufacturing divided by agriculture, you get the terms of trade. In FY05, the ratio was 1.29, meaning manufacturing had the upper hand.
And now, in FY25, it dropped to 0.65.
That is collapse. Manufacturing has lost half its relative pricing power compared to agriculture. Why? What's going on? Two opposing forces. Force 1, manufacturing. It faces brutal global competition. You can't raise the price of a smartphone or a car easily because a Chinese, Vietnamese, or Korean competitor will undercut you.
Right.
Plus technology. Plus technology inherently drives costs down over time. Force 2, agriculture. It is heavily state-supported. We have MSP, the minimum support price. The government politically guarantees price increases every year to support farmers.
So policy pushes ag prices up, while the global market pushes manufacturing prices down. What is the real-world consequence of this?
This is the aha moment for your mains answer regarding employment. If you are a worker or a small investor, where are the price signals telling you to go?
To agriculture.
To agriculture. If farm income, which is driven by high prices, is relatively attractive compared to a factory wage, which is suppressed by tight margins, why would you migrate?
You wouldn't.
This explains the reverse migration post-COVID and why 45% of our workforce is still stuck in agriculture. The price signal is keeping them there.
This challenges the Lewis turning point theory that we all study.
Completely. The Lewis theory says as an economy grows, labor moves from low productivity farms to high productivity factories. But in India, the terms of trade are acting like a dam, preventing that flow.
But the survey notes, however, that corporate profits haven't collapsed. How is that possible if they have no pricing power?
Efficiency. If you can't raise prices, you must cut costs. You automate. You use robots. You optimize supply chains.
But, and here's the irony, this means factories need less labor.
Precisely. So the factory isn't hiring because it's automating to survive. The farmer isn't leaving the farm because prices are decent. What's the result?
Jobless growth.
Jobless growth. It's a vicious cycle for employment generation. And it links to 2013 GS3 question 6 about the Pink Revolution.
How so?
The Pink Revolution, which is about meat and processing, is about moving up the value chain. But if the terms of trade favor raw agriculture over processing, which is a form of manufacturing, it is hard to attract capital into that processing layer.
Yeah.
Also look at 2014 GS1 question 6 on economic policies. When you discuss the failure of manufacturing to absorb labor, don't just say skills gap. That's the easy answer.
Everyone writes that.
The rank 1 answer says, the declining terms of trade for manufacturing, which fell to 0.65 in FY25, creates a disincentive for labor transition, structurally hampering industrialization.
That is profound. It's not just that people aren't skilled, it's that the market is telling them, stay on the farm.
It's a structural reality.
Let's zoom out geographically. Section 6, regional dynamics.
Charts V.17 and V.18. First, rural versus urban. Historically, rural inflation was higher.
Why was that?
Because rural consumption baskets are 50–60% food. When food is expensive, villages suffer more. But recently, because of the food deflation we discussed, rural inflation dipped below urban inflation.
That's a relief for rural households. But looking at the states, the disparity is wild. Kerala is seeing inflation of 8.05%, and Delhi is seeing 0.96%. We're in the same country, using the same currency, under the same RBI. How is this possible?
The survey discusses the mean gap inflation study. The biggest correlation they found is with wages. Kerala has high daily wages. When you pay people more, the cost of services, plumbers, drivers, cooks, goes up. That drives service inflation.
Yeah.
Delhi and Uttarakhand have lower wage pressures or better supply logistics. Also, the South and Northeast tend to show persistence. Once inflation goes up, it stays up. It's stickier.
This brings in the federalism angle. 2016 GS2, question 11.
Yes, effectiveness of the government system at various levels. We often think of inflation as Modi Ji's problem or the RBI governor's problem, a central issue.
Right.
But this data proves that state-level dynamics, labor laws, supply chains, state-level fuel taxes create vastly different realities.
So a one-size-fits-all policy doesn't work.
A one-size-fits-all repo rate from the RBI might be too high for Delhi, potentially crushing growth, and too low for Kerala, failing to stop inflation. This is a huge challenge for cooperative federalism.
That is a great point. The blunt instrument of interest rates struggles in a diverse continent-sized economy. Let's wrap up with the crystal ball. Section 7, Outlook.
The RBI projects 2.0% for FY26. The IMF is a bit more conservative at 2.8%.
So both are very comfortable.
Very comfortable. Basically, the Goldilocks scenario continues. We have a good Kharif harvest behind us. Rabi sowing is strong. Reservoirs are full. This all points to tamed food inflation.
But we have to look at the risks. There are always risks.
Always. 1, geopolitics. 1 missile in the wrong place in the Middle East, and oil spikes. That's the perennial risk.
True.
2, base metals. As we discuss, if the AI and green tech boom accelerates, copper and aluminum prices rise. That raises input costs for every single manufacturer in India.
And number 3.
3, the gold illusion. If the world stays scared, gold stays high, and our core inflation number stays optically high, potentially confusing the public narrative and putting pressure on the RBI for no good reason.
But the survey's final verdict is calm.
Yes. They say inflation might tick up slightly in FY27, but it is unlikely to be a concern. The beast is tamed.
Tamed and anchored. So let's summarize this deep dive. 1. Headline inflation is historically low, around 1.7%, but it's driven heavily by base effects and crashing vegetable prices.
But don't get too complacent.
2. The core inflation stickiness that everyone was worried about is an illusion. It's caused by imported gold volatility. The real domestic demand is stable.
The economy is not overheating.
3. Copper and AI are the new drivers of global supply pressure, something to watch for the future.
The new inflation battleground.
And 4, and I think this is the most important, terms of trade have shifted decisively against manufacturing, creating a structural trap for labor mobility in India.
And that is the thought I want to leave you with. We have Make in India, we have PLI schemes, we want to be a manufacturing powerhouse.
As a national goal.
But if the fundamental price signals of the economy, the terms of trade keep favoring agriculture, are we swimming upstream? Can you industrialize an economy when the market rewards farming more than making widgets? How do we fix this without hurting the farmers who rely on high prices?
That's a huge dilemma.
That is the policy dilemma of the next decade.
A heavy question. Can we industrialize if the prices tell us to farm? That wraps up our analysis of Chapter 5. This was dense, but we hope it gave you the ammunition you need for GS3 and your essay papers.
And remember, knowledge is only useful if you apply it. Go look at those PYQs we mentioned. Try to draft an answer using the terms of trade argument. See how it feels.
Please, if you haven't already, subscribe to Simplified UPSC by PPP. Your paid membership really does allow us to do this research. We couldn't do it otherwise.
And check the Telegram for the notes. Legend members, see you on Discord for the model answers and the extra PYQs.
Keep learning, keep analyzing, and don't let the headline numbers fool you. Always look for the core truth. See you in the next deep dive.
Goodbye, and study hard.